Let's start. We're doing valuation methods. But actual roughly I just move to the binomial now. But what we have done is binomial. Let me quickly discuss. Check the voice. Now let me slightly do with you what will binomial do. Binomial, as the name will suggest, one price will have prices upside and downside. Now let's suppose I just take a rough number. Let's suppose you have 100 rupees here, expected to become 150 or 70. The limitation of method. Assume one price is upside downside. Accordingly, you can do it. Common method in your exam, which under binomial, is risk neutral. Risk neutral is a part of binomial. Now there was a controversy. This happened. I'll discuss with at the last stage. What you'll do in the exam for the time the binomial comes or risk neutral, what you'll do. Although if I look at your study material and try to show, they have given single method under binomial and the risk neutral. Only difference is they calculate some terms called U, R, D, etc. that they come under the provision of binomial, although this could be risk neutral only. And in risk neutral, they simply apply with certain parameter which I'll explain to you just now. Let me something before I move. By chance, for example, look at this. Now, for example, it says using binomial model, calculate the value blah blah blah, calculate probability. That's fine. Probability, this method. When exam question binomial comes, the normal way. If by chance they segregate, then during the classes we discuss something called option delta, which I'll discuss with you, but not so aggressively because the one method can be applied. The R minus D, U minus D, etc. Everything will be done the same way. Then suddenly they move to risk neutral. And at the second point, they'll say using this model we can derive the risk neutral probabilities and apply the same probability in the binomial model. Basically, that's one and the same. I don't know why it's or they want to be I don't know, research analyst will be keep doing binomial and risk neutral. Practically, people apply put call parity theorem. The weird thing is, but anyhow, since exam, if nothing is said, binomial what will do exactly same way. Only difference is this structure which is here. It is nothing but I'll try to explain what this is. Why normal? Actually, in the binomial, we'll try to find risk neutral probabilities. If I find risk neutral probabilities, that automatically becomes a risk method only. That's the most used method. In fact, when you go back home, open up a study material, you'll find that only. Once in a blue moon, they have asked option delta. That option delta we calculate and do it. But using that option delta, I can apply binomial in two different modes also. But when you will find out, you will not even come to know that what is being applied. So do not get worried about it. Once in a blue moon, you will have these kind of a problem which will remain. Cannot under the sun learn everything. That's for sure. The objective of the risk neutral, let's suppose I'll use word very clearly. Let me use a word binomial only. That what you have been doing. Binomial, if I use under binomial, the most used method is risk, which tries to find out risk neutral probabilities. Try to see what it happens is basically the terms would come as U upside, factors comes U, D, etc. R. Now, if let's suppose I do not calculate those probabilities, then also I can calculate the answer. Basic objective of that answer is basically you need to find a P and 1 minus P such that 150 into P, 1 minus P into 70 should be equal to 100. Now, since this will be happening after a point of a time, this will be happening. For example, let me assume some rate. Let's suppose I'm assuming a 3% rate of interest. I'll make this an example, don't worry, at some point of a time. Let's suppose rate of interest is 3% and this is 1 year uh, time period only, I'm assuming. So what generally will be done is, you say, by actually using this data, what I'm doing, we try to find risk neutral probabilities. We say 150 into P plus 70 into 1 minus P. This will be happening after 1 year. Divide by 1.03 should be equal to 100. If I try to find, I'll get the probabilities. So if you try to solve this out, you'll say it will go here. This will be 150p plus 70 minus 70 is equal to 103. And when you solve this, I think you should get, anyone who can tell me rough numbers? Can tell me rough? 41 point something, 0.4125. This is direct way if I do. Now let me suppose if I use a upside and downside factors. Do not copy it, no need to copy, because we'll be doing ample number of practice. Then at the end I'll tell you, if in exam by chance it comes binomial and risk neutral, both he asked in the same part, then basically he is asking some other approach to option delta that came couple of times in exam. In a normal question he has asked option delta. We do it, but we do not focus so much of a spend over time. We do some borrowing, etc. Anything can be done. He has used, I think, riskless approach maybe. This is one way of doing it, risk neutral method. Second way of doing, when under binomial, when he does, what he do is, this is US upside, this he treats as downside. We find factor U, 150 divided by 100. How much? 1.5. Then you find what? D, 0.7. R is basically a 1 rupee invested today. It will become how much after the 1 year? R becomes 1 point. Now if I find P, my formula is, I'm not doing a derivation, although we can do the derivation in normal class, we do the derivation and so on. It's R minus D divided by what? 2 minus D. Now this will be, R is 1.03 minus 0.7 divided by 1.5 minus 0.7. So basically either you apply US, DS, and this is actually a S concept and use this way of doing it, or you say 150 into probability 70 into 1 minus P. This is happening after 1 year. If it has to be equated to 100, then what should be the risk neutral probability? I think you should get exactly same, 0.4125. So let us, I'm general, I've discussed with you. The secondary part I'll discuss, that is much easier in fact. But the problem is it's not commonly used, hence you cannot even imagine it out. He did not ask any kind of a borrowing, etc. But if he gives binomial, I'll show you the questions also from the exam when he'll say, calculate under binomial method, calculate the probabilities. That means basically, indirectly he is saying binomial, you apply the risk neutral probabilities only. Let me pick up the questions one by one and then we move to the one example I'll take in which I'll modify something. This is 2 time step. Let us look at question number 11 in fact. Let us look at 11. Says what price 300, risk free rate 5% per annum, non CC. It does not say, assume non CC. Find the option premium of 1 year call option with a strike price of 300 if the possible prices are 330 or 285. So upside downside, you have a normal way, whatever you've done, apply that only. Upside downside, I have U and D I can calculate. This is how much period? 1 year. So what I'll do is, I'll just show you. What we'll do is, 2-step I am not doing as of now, step we'll learn to. 2-step is basically extension of it, nothing else. What price is S? U would be what? 1.10. D would be 0.95. RF 5%, R 1.05. exercise price 300 was given, option is call. So how do we do it? Probability of a price going up, P 1 minus P. If you do not want to find this P, if he says pure risk neutral, maybe you can avoid P, etc. and then do it, still it is same thing. You multiply 330 into P plus 285 into 1 minus P should be divided by the factor, should be equal to the present value. Basically what we are saying, in a risk neutral world, I should be having the same, the way of understanding or way of talking changes. So I think just calculate, I think someone calculate number, it should come 0.67. It's just for the practice. 0.67. If you multiply probability of a price going down, probability of price going down would be 1 minus 0.67 is equal to 0.33. Value of call today is P into CU plus 1 minus P, that gives you 19.05. Check the numbers once please. Sir, do we have to remember this formula? In case you cannot remember this formula, then objective is probability into 330, 1 minus P into 285. Actually this formula is a derivation from here only. Probability into 330 plus 1 minus P into, I am doing it here only. What I want to say is, when I multiply P into this plus 1 minus P 285, this will happen after 1 year, divide by, this counting factor is 1.05. It should be equal to what? 300. Try to solve anyone, you should get exactly same number. Actually during the classes we do some derivation, and generally your institute uses this formula, so we use R minus D, U minus D. It's basically in the risk neutral world we try to equate this number with these two numbers and so on. To solve this, I think should be getting exactly same number. 30 plus 5 into get same thing. Now that was one step model. Now if you try to look at two-step model, in the two-step model what happens is, for example, one price can have two prices. Let's suppose 100 can have upside of 120 and 8. If I show you this, only this part on the right hand side, this part, it appears a one-step model. Now when again upside downside happens, that means you will have, this is called two-step model. Basic idea is, these values whatever comes here, you try to bring first at this node values, I'm highlighting in yellow, two values, using probabilities, calculate the value here, and then you use these two values, calculate the value here, and then you arrive both the values, this value and so same step you will be applying times. Again I am saying, when you apply this step, it is called one step. That means the value CU, CD, you bring back to what? C0. That you can call it as C0. If two times steps happen, if this is CU, let's suppose, this becomes CUU. This will become CUD. This will become D and U. CDU. This is CD. So basically what you do is, if some value comes here, whatever value comes here, we say this value into probability, this value into probability, discount by whatever is the time period here, and you arrive at, you can say it is a node B basically. Then you have value arriving something here, value arriving something here, bring back to this period, values bring back to this period, and now these two values bring back to this period. That is called two-step model. So in two-step, basically same exercise is done 3 times. So what you are doing in one step, only multiplying, which you were getting P into CU minus P into CD by R, this directly was coming from this level to the 0 period. In the two step, it will come back by 1 and 1 period. 10th question as a general warm up, let's see. 10th question as a general, we'll see. The stock price starts at 20. In each of the 2 time step, it may go up down by 10 or 10% up and 10% down. That means you will have either uh, the value will come as what? 2 times will be 22 or 18. Then again 2 times. Each step is 3 months long. Risk-free rate is 12 percentage per annum it is given. So accordingly divide into 3 months. Total months would be 6 months. 3 months. And strike price is 21. Do not make a confusion of the strike price 21. What is the value of call option according to binomial model? It's a decision tree approach, basically you can call it as. When I go back here, what I do is, these are actually European. American also I'll do with you, just to explain you something. Now in this case, if you look up first part, please look up and try to tally. The numbers were given to you because one exercise I'll ask you to do on your own. One question I have not given the answer, so discussing this probably with you. A $20 to 1.1.9 RF 12 percentage for 3 months would be 3, and R capital R becomes 1.03. So we have a 3 months period, we have what? 6 months period. If it is node A, for example, at node A we are standing, node B, and this is node C. What you do is you draw, I'll draw for you so that it becomes neat. 20 will either go up and down, it will become what? 22 or 80. In second time it will go up and down, how much? 2, 19 point. This will be 19.8, although I can show one and the same thing, but I show it separately. This is 16.2. Your exercise price was 21. This will be lapse, this is lapse, and this is lapse, 0. These will come 0. This will come 3.2. This will come 3.2 because it becomes 24.2. So what you'll do is, you'll find a probability P. So when I find a probability, formula is R minus D divided by U minus D. R was 1.03, D is sir 0.9. How did we get 10% downside and upside? 0.9, 1.10 divided by 0.9, it comes 0.65. So 65% probabilities of the price going up. We have 0.65, 0.65, 0.65, this 0.35, 0.35 and 0.35. Now in this case, 3.2 into 0.65 plus 0 into 0.35, bring it back 3 months, divide by 1.03, you will get some value here. Basically you are calculating the present value, nothing else. 3.2 into 0.65 plus 0 into 0.35 divide by 1.03, you will get some value. 2.019. Then you can calculate 0 into 0, it will become 0, and then this into probability, this into probability, you bring the value here. Done? If I show you the answer now, this becomes my step model. Means my 0 period value will become $1.74. Now I am moving into American. We'll do as per European first, exactly same way, no change in that. Then I'll tell you, actually 2 times question come on, I think on the American, both the time answer has been exactly same, but there is slight difference between the American and the European options. We'll do European and then I'll tell you in American what has to be done. By chance the answer is coming same in that question, answer is not given to you, so you will have to do on your own. The 2-step model, what we have done now, exactly same thing you'll do on your own. I'll move to question number. This was 10th. 14th question is a missing figure. You can do at a home if you want. Answer is given to you, or let me know. I'll ask itself. 32nd question. 32. We do it. Consider 2-year. This make it as a B part. A part make it as European. What we have been doing was European. In American option, slight care has to be taken. This will once we move back. Consider 2-year American call option with a European call option. I'm not reading your American. European call option, strike price of 50 on the stock, current price of which is also 50. Assume that there are 2 time periods of 1 year, and each year stock price can move up or down by equal percentage of The risk-free interest rate is 6%. Using binomial option, calculate the probability of price moving up and down. Also draw two-step binomial tree. Now look at the word he's saying, probability of price moving up, a binomial model. So do not have the doubt, binomial risk neutral is part of binomial only. Some of you have a confusion, but again I'm telling you what I said. You will try if both of them same question gives and two types of answer will come same. If differently you have to do, then what has to be done, that will take care at the end. Let's first do, because I think more than 95% it's a risk neutral every time. Only once delta he asked, that also we can calculate easily. 32, do it on your own please. Please do it. The answer would not be available with you. Number 32. Done. Done na? Was my chart. Chart you have a spot price 50, U 1.2.8, RF6, capital R 1.0, and I have a binomial tree. Comes out first year, second year, probability is coming 0.65, probability is 0.5, which comes out CUU, that's 2 time upside 22, 0 CD is 0, it lapse happens, and value of call which I am getting at node B is 13.49, node C I am getting is 0, 0. node C and node A discounting back of 13.49 in this. Basically, how did I get was getting probability of price going up 0.65 value of call at node C into C. Then we have 0.65 into 0.2 0.350. Now value of call at node C, exactly same thing comes. Now this is exactly what you've done in European. American, by chance the answer comes same American, but an American actually can be exercised any point of a time. Right, care has to be taken every time when you stand here. You have to compare this. This is called, which you have calculated as a discounting of 22 and a 0. This value should be compared with the intrinsic value. In exam, 2 times question has come, nothing has happened, I think, by chance, but by chance it happens. Then, for example, the first year you have, first year the exercise price was 50. If you exercise, your intrinsic value would be 10, whereas the value comes what? 13.49. The answer would be 13.49. That means at each node you have to compare. In American option, intrinsic value with the discounted value, and higher of the two would be selected. So what has to be kept? This is what we do in this American option is we compare the discounted value, which was 13.49. Discounted value was 13.49. Intrinsic value would be 10, 60 minus 50. The higher of the two would be kept as what? The value. Although the answer is coming same, because by chance, what is the difference, sir? European is at the expiry, American is anytime. So in American, basically you will have is what? You'll have to compare these two values. If intrinsic was by chance coming higher, then you would select this. So here you have to keep basically in mind the intrinsic value in comparison with the discounted value. You have to compare intrinsic and a discounted value, and then accordingly you have to call on it. Comes out. Value of call at node C would be same. Discounted value was 0 and intrinsic value is also 0 because option would lapse. The option would lapse, and since the option would lapse, accordingly the value would come as only. Value of call at node A with discounted value and intrinsic value. The difference in the American European would be, in American you have to compare, although you instead directly write the answer because he says the European and American answer I think is coming same, and accordingly writes or notes. But American, the carefulness has to be kept that at each node you are comparing the value. Done. Now let me go back one question from the book. I'll do in two ways. First is the normal way which you have been doing, then I'll slightly modify it so that you understand what exactly happens. Let me come back. Delta. Read question number 1. Read question number 61, please. Now, if we try to look at this question, everyone would have seen or would have done. It's a asking you to first part is combination of a share and option. Sir Dayal should select if he wants a perfect hedge. You can call it as a hedge ratio. It can be a delta or it can be option delta. Let me read out. Not do anything. Let me read out. Mr. Dayal is interested in purchasing equity shares of ABC, which is currently selling at rupees what? 100. He expects that price of share may go up to 780 or may go down to 480, upside and downside. The chance of occurring such variations are 60 and 40. These are not the risk neutral probabilities. These are his normal probability, what he expects. 40. A call option on the share of ABC can be exercised at the end of 3 months with a strike price of 630. First part he says is perfect hedge. What to do? And then what should be the value of the option today if the risk free rate is this? I can use now, there's something called riskless hedge approach, or I can use first part is hedge only, this ratio. Second part, basically you have to find value of option. I'll do in two ways. One way I'll show it to you, second way we'll do it after I do one example. And then he says what is the expected return on the option. This hedge ratio is nothing but it's a combination of when a writer is writing a call, he has to safeguard himself by buying some share, that is called a hedge ratio. How much proportion buy? Now the proportion he should buy is, it's a spread of the possible we get is option values, that is basically 630 is exercise price, it goes to 780. C is how much? C is how much? 150. 150 second case it will perhaps 150 minus 0, that's CU minus CD, divide by difference of 780 and 480. How much do you get? 0.5. What is the meaning of 0.5, sir? For every one share, half should be what? Let's try that out here only. I'll do in a normal way what we have learned just now, and then we'll move to something different. That's 780, 480. What we do here is, if I go back, try out normal way, and then I'll modify this answer. We have, let's suppose, hedge ratio. Hedge ratio is nothing but spread of possible option values divided by spread of possible prices. 600, 780, 480, 150. CD is what? 0. 150 minus 0 divided by 780 minus 480. We get what? 0.50. So how do we read 0.50? He should purchase 0.5 shares for every one call option return. He will be able to hedge. Now second part I have done what we have done just now. Using that I'll modify using some other approach. Value of option today he asked. What price is what? 600 US, 780 U, 1.3, T is 0.8, RF would be 2.5, R becomes what? 1.025. R minus D divided by U minus D, it becomes 1.025 minus 0.8, 1.3 minus 0.8, you get what? 0.45, and then you get what? P into CU, 1 minus P into CD by R, and then you get 65.85. Now I am trying to create second part using something called a riskless hedge approach, in which no matter what happens as expiry, your portfolios will have same value, irrespective, would have the same values at the expiry, irrespective what happens. And what does it mean? Alternatively, please. First part you calculated what? Hedge ratio. Hedge ratio. And that came out it's actually a delta. 0.5. Some people call it as option delta or delta. Second part, what I do is, in this part, I create a portfolio, or I say, let me try to find payoff at maturity. Let me try to do payoff at what are the two expected prices or maturity? 780 or how much shares you bought? When you'll go back home, you'll be able to see is done. But I do it with the borrowing. I'm in a different way now. Sell 0.5 at the rate 780. When you sell, you'll get how much value? 390. And if the price becomes 480, then you will get what, sir? 480 into 0.5. How much value? 440. Now, call option. Call option would be exercised. It's a written. Is right. We do it from the writer's point of view. In this case, it will be exercised against the writer. What was the rate? 630. 630. 630 becomes 780. How much loss? 150. What is the payoff after 1 year? 40. In this case, call option would what? Again become what? That means it's a riskless portfolio in which the same values would be there irrespective what the price becomes. That's the assumption of the model. Now, when I find a value of a call option, we try value of a call option using this. Actually, what is the objective of this method is, at the end I'll get 240. Today I'll have to buy what? How many shares? 0.5. Do not copy anything. I'll maybe dictate a sentence to you so that it becomes formal. So I want to buy a share. What is the price today? 600. I want to buy 600 into 0.5. How much rupees I need? How much rupees? 300. And some amount will be coming from the call option writing. Some amount will come from the call option written which I write, which I do not know, which I have to find, minus C. This should be equal to the present value of this 240. This should be equal to the present value of 240. Different way of doing it, difference between the C and the present value could have been the case of borrowing, lending and so on. It also becomes one of the methods, but anyhow, restrict yourself, because at the most you'll move into this side, which we have seen. It's 40 and 240 will be after how many years? 6 months. What was the time factor? 1.0. Now try to solve and tell me C value what comes. Sir, what is this done? I'll dictate the sentence, don't worry. It is basically you have to buy this share. This is the call option, and this is basically we are trying to create a riskless portfolio in which no matter what the price becomes, answer is same. So this 600 into 0.5 minus C is equal to 40 divided by 1.025. C would be equal to exactly same as 65.85. So basically what has been done is here, this is nothing but the PV, basically we say the present value of 40 to what price into delta. That means I'll buy the share, it's a delta. What price delta minus C. Sir, what is this? C is the institute, I think, uses a P. We use the word call option. Basically, payoff at maturity would be equal to 780, 480, and 240, 240 SP into delta minus C, call option. Now you can copy that. Then I'll take one example in which I'll do both the methods again. Copy that part. Sir, what have we done? 600 into 0.5 is the total cost of buying the share today, because he is buying 0.5 shares. Buying 0.5 shares. In the next question, I'll dictate this sentence. Buying 0.5 shares. Call it as, he buys 0.5 shares, he basically hedged him. C is the money he'll receive from call option premium, and this is happening what time period? This part, first part, 0 period. 240 is happening at the end of the whatever time period. Discount back. So premium, I think you should get 65.85. 5 point. You go back home, just check once where I have done option delta. I think I would have done by borrowing also. Only takes at the end he proves. Concept of option delta I would have done. When you go back, that I think has not touched till now. What the amount he borrows basically borrowing. So just increasing your workload, nothing else. Practical life, the people who use PCPT, I'm telling you again, majorly, basically try to look at the value of the one option and try to create the spot price, exercise price, present value, and arrive at a value. But anyhow, since it was given, it's okay. This one part we have done. Now, my advice to you would remain is, although I don't know whether how your institute looks at, if the hedge ratio is given, I think value of call option can be done by anything. But in exam, if it finds a hedge ratio first, then try to utilize this part. That it becomes basically maybe he's connectively asking it. Answer would come same. I'll use one example soon after this, in which I'll tell you if he says calculate value of call option, simply use risk neutral method. Even if he says binomial, we have seen, go back home and check, he'll use risk neutral only. If he says use risk neutral and binomial, then that means you have to apply a different, then we'll apply this kind. Although there could be one more which we can go, but let's not go into the research of it. We'll do it this part, and then third part was straightforward, in which he says get this value 65.85. This the price actually becomes 780. You end up earning 90. If the price becomes 480, you end up earning 0. Value of call would be 90, so 5.85 value becomes. These were not risk neutral probabilities. These were the probable prices. What is expected value of a call at a probability of 60 and 40 percentage. In 40 percentage, value of call would be 90, and you will get expected rate of return as 36.67 because you entered at what 65.85. Entered at 65.85, and 90 minus 65.85 divided by this. Let me take one example now. If he says option delta, then you have no choice. Delta have to be calculated. Now let me take an example. I try to use down the example. Down example. What price? Time. Months. Size price. First rate. Per annum. Two possible prices on expiry. Possible prices on expiry. Now check. The voice audible? Coming right now. Let's put down two possible prices on expiry. 150 or now let's suppose this question is given and nothing is given. You'll apply what? Risk neutral. Apply the same. That's binomial even if it says I am using a word risk neutral only. Risk neutral. What you will do is, let's suppose not calculating U and D, let me directly do this way. So I'll do 100 rupees comes what? Although you can calculate U, that will probabilities will come same. 100 will become what? 150 or basically we find probability under this is 150 plus 70 into 1 minus P equal to, this is what after 1 year na, divide by what rate? 3 months. 3 months would R would become 1.0 1.03 equal to 100. P will get as what? Is equal to 0.125. Value of call would CU 95 exercise price I gave you. Q would be equal to 5. CD equal to 55 into 1 plus 0 into 0.58 5 divided by 1 point. Now in this question only I mentioned this was, even if you had said binomial you could have used this. Let's suppose now I mention use binomial. Now let's suppose I say and do nothing. First part is exactly same way. Find out hedge ratio. Hedge ratio you can call it as delta. That will be nothing but if I use this graphical presentation on the spread, it's a difference of these two 55 and 0 and difference of what? 150 and 70. We do 55 minus 0 divided by 150. 55 divided by what? 80. 55 divided by 80. How much do we get? 0.6875. If you want to put a sentence, please put down the sentence. Want to put this sentence, put down the sentence. Still problem? Check. Check once, please. Let's put down the meaning of 0.6875. The voice is not clear. Please, I'll write complete. Don't worry. Into it. Let's put down 0.6875 means what? 0.6875 means is per option written. He will buy. Down a sentence if you want. Normal classes we would have written. I'll dictate once again. Per option written. If writer buys 0.6875 shares. Per option writer buys 0.75 shares. Then he would not be at a loss whether the price becomes 150 or 70. Whether the price becomes 150 or 70. This is one language. Or second language, I could have said if he buys 0.6875 share per option return, then he would not be at loss whether the price becomes, we have taken what price is 150 and or 70. Second way of writing could be if he buys this 0.6875 share, payoff on the expiry, automatically payoff on the expiry will become same. So I am using that payoff because the becomes a riskless for us. Now hedge ratio once you find, and this do it only when in the same question is asking both the methods. This was first part I did. Second part, let me find payoff at maturity. Right. Try that out. 150. He'll do what shares he what he'll sell. Sir, how can he buy the share in decimals? Out in 75. How much? 10 point. In this case it will be 0.675. 48.125. Then call option. Perhaps exercise. Writer since writing 95. He lost what 50. Payoff will come this and is 0. Perhaps call option. I think both comes 48 point. Third part. Value of assume C is equal to call option present value of 5. Although we can make solvent, there are ways of doing equal to what was the spot price? 100. 100. That's delta which you have calculated, but I'm writing here. It's spot price delta minus present value of this price. 100 in 0.875 would be the money required. Some money would come from the call option. That should be equal to 48.12 divided by 1 point. Solve and tell me. Left hand side would be 8.75. Right hand side would be 46. Point. Let me take one example which will do independently. I will not do it. Current market price, spot price, exercise price, maximum price. That's request I'm writing upside basic, upside possibility 520, and minimum price just per and 8% interest per annum C 8 e to the power RT 1 point time time is 3. Calculate all options. Binomial and now certainly when he is asking in binomial you will not apply risk neutral separately. At that point of a time you will be using two different varieties. Otherwise simple method you could have used one and the answer could have. Do call option using binomial, calculate what? Delta. When you go back home, rudimental for binomial they'll be solving by risk neutral. Even in a same question they're giving price was what? Upside 5, downside. Try on your own. I'll check voice is okay. Now you can tell me how much value it creates upside. U 70 delta when you calculate 75 divided by how much point? If by chance question, now let me add some more points here. If he says calculate the initial investment, he uses the word because 100% sure you can use these. They say calculate the initial, how much? 0.51 into 450. Actually, what are we trying to do? If you look at this, what we did was requirement was 100 into 0.6875. This is initial investment. Some money would come from the call option. That we are finding call. Actually, when you go back home, if you go back and try, I would have done something called borrowing. Rest comes from the borrowing. There could be another way of doing it. That another way of doing it. So I'm not going into so much depth because they're asking. They're basically creating me for a PhD level student. Requirement 0.51 is you be able to read 0.51. That means for per option return, he'll buy what 0.51 share. If he gives initial investment, that initial investment would be 0.51 into 450. Anyhow, we require that. Next part, what we do is payoff. Sir, should we calculate both the payoff? It is not necessary. I am showing you both the payoff for the purpose so that you can take any payoff. So ultimately, present value of that payoff should be equal to the amount required minus the call option premium. I am showing so that you are not making any kind of a mistake. So in exam, if you want to show, it's okay. Otherwise, you can ignore that complete payoff. You can simply do is 378 option would lapse 0 and you will sell 378 into 0.51. How much do we get? 378 into 0.51, 192.78. So you can do one and solve it. I am showing both so that you know that both the payoffs are coming what? Same. The objective of riskless hedge approach is actually that the portfolios will give me the same at the end answer. I write here calculate payoffs. These payoffs are it. What we do is any of the prices. Price becomes 5 to 8. Get what here? Sell shares. 5 to 5. Call option. 5 1. 192.7. Would be 192. How much loss you have here? 70. First one gives you 1 point. 0.75. Rounding off is coming. That's fine. Third is value of call. We assume C is equal to option. Try to come. What price delta minus the call. What price is how much? That was point. This is called total initial investment. Money would come from the call option to be 190 divided by what? 1 point. Anyone who has done this C directly take 24.4 2 5 2 Answer would come same. Answer would come same. Try the second. I'm saying he has used the same question. It has to be done this way. Right? Could have simply done by second method. Now in this case, it upside. Actually, this is the formula P plus 1 minus this after 1 year divide by capital R what spot price equal to spot price or SR we say in our working when you go back home and try to open up your derivation you'll open P into US plus 1 minus P should be equal to SR. So exactly same thing we are doing it here. Is US is how much? S is how much? 5 420 into 1.024 1 minus value of all of the flow period plus 1 minus capital R point plus divided by done. This question came in 20 I think. How much you are getting here? 0.34 that 25 actually capital budgeting you would not inflation was finals would be we have two methods discounting problem comes now what we do there is whatever comes by one also round off and what we do we have done the bond valuation. The bond valuation calculate by YTM method and you try to calculate answers you'll find that if you solve the intrinsic value would not come same somewhere we try to match that out maybe because of the rounding off so make sure whatever comes here write that only wherever is more rounding off na take that as a equal to the previous one this place was lesser rounding off This place would be a major rounding off because I think these are not exactly 0.34, 3434 something. Major rounding off would be there. Hence, if we have to compare both of them, this answer match with, because they'll be blindly checking the paper. Since both of them give me same answer, I know. Previous case, we did not have the rounding off. The previous case, maybe the rounding off was such way that answers were coming approximately. The rounding off, and this will not happen here. The capital budgeting, if you do the inflation concept by using real discount rate, nominal discount rate, there will be a concept of real nominal discount. Use that same data, catch them. Otherwise, you will not have the same answers. Anyhow, it comes approximately, then make sure both right, 25, 25 and right approximately. Which questions are left? 78 is a general call option exercise labs. It's try as a whole, right as a. Can we move into the currency derivative? Rest you can try up now. Data management we did now. Yes. Let's move. Let's start. Start with currency derivatives. Start with currency derivatives. The slide which is open in front of you would be the most important of all these slides. I'll try my level best to explain the logics. Anytime if the logic fails, because in currency derivatives, question would not come in the same currency in which you have to. Actually, problem in currency derivative. First, I'll tell you. Derivative. What we do is just an option 2 we have done. In the entire chapter of derivatives, you were betting either on Reliance, Idea, or any of the share. One was share, second was price. It could be in rupees, it could be in dollars, it could be any currency. You do not have any problem. The problem which happens in this chapter is you will have yen, one currency, let's suppose. Second is rupee, dollar, relationship between any of the currencies, and you will have to identify which currency has to be bet on. That means betting has to be done on which currency. In the shares, it was known either I'll buy the share, I sell the share, either I take the call option on the share or I take put option on the share. In this case, I can do F plus on dollar, F minus on dollar, I can do F plus on rupee, plus on rupee. That would challenge me out. First, we'll identify by looking at the question data. How do you identify in the question what is a commodity or what is a share? In fact, do not read both currencies as currencies. The moment you will read both currencies, 99% you will make a mistake in the question. The way of reading should be read one as a currency, one as a commodity and one as a price. How to assume or how to know, sir, what is a commodity, and after that I'll come to you. A summary I'll show you. That summary, no matter what happens, will never fail you. No matter what happens, you'll always be able to. How will identify what has to be done? Our particular scenario here. Now look at this question. I'll look up one by one. For example, first question you do not open up. He says currency future contract size is rupees 4,72,000. Contract can be only of a share commodity. That means whatever you have to take action, whether F plus, whether F minus, whether C plus, whether C minus, whether P plus, whether P minus, it has to be in rupee. Second currency, whichever is given, dollar, is price. So it becomes very uncomfortable. How can rupee a commodity? Rupee is a share here. So I'll say one share is equal to how many dollars? One share is equal to how many dollars? That would be the way of reading. One way of looking is contract size would be in a commodity. That means betting would be done on a rupee. Second way of showing is this example question number 3, for example. In question number 3, he gives you euro, USD, USD, INR, euro, USD, and call put, etc. He gives. Now it's difficult, maybe prima facie identify which is a commodity, which is a price. Then I look at premium. If I look at premium, premium would always be in the price term. Premium would be in the price term. Premium is in dollar. That means as per the question, commodity is euro. I'll do betting on the euro. Sir, what does it mean? It says call option. I'll take a call option, maybe C plus C minus, depending on the question, on euro, and then I'll say call option taken on this share and price is 1.2. Because the moment I read euro USD, it will be confusing. I'll say this is $1 1 point. It means if let's suppose I was taking C plus, if let's suppose I was taking C plus on idea, strike price was 1.2. I'll say I'm buying the call option on idea at 1.2 and I'll benefit when the price goes above 1.2. Similarly, read the language. This is a share I'm buying. Let's suppose I'm buying C plus on share at what rate? 1.2. Profit will come when the price goes above 1.2. Do not look at this. This is irrelevant for you now. Once you identify in the question which is the commodity, assume that to be a share, right hand side is a price, and then come to the normal. Call option upside, put option downside, future plus upside profit, downside loss, F minus downside profit, upside loss. That is exactly what we do. Premium is in dollar, commodity is euro. Premium in dollar, commodity is euro. Premium in rupee, commodity is USD. Premium in rupee, commodity is USD. That is how I identify. Now going forward, every question will say it's the same thing. For example, in this question it say contract size in GBP 1500. That means as per the question, I can take contract only of GBP. That means I can buy GBP or I can sell GBP. That is exactly I can do. And second is a price term. So you cannot convert the question as per your own wish. It has to be done the same. Two things to remember. If you want to write, that's your choice. Contract size, by looking at contract size, you will identify that is a commodity. Or by looking at a price, a premium would be in the price term. Contract size would be in the commodity term on which you are betting. That is the way of identification. First prima facie rule of the chapter. Now let me go to my main slide, which I do. This chapter confuses a lot. Although I consider this to be one of the easiest chapter because answer we would be knowing when I start the question. That's best part of it. Yes, I know it. The only problem comes in when the cash market rate is not same future price, because that's slightly different. Look at this part. First I am talking about exporter and importer. Exporter basic rule is what? He'll receive foreign currency and he'll sell foreign currency. Let's talk about exporter only. He'll receive foreign currency and he'll sell foreign currency. Now suppose dollar comes to you. Normal, let's go to the normal foreign exchange chapter. If the foreign currency comes to you, what type of contract you will take? Buy or sell? Sell. Selling is F. Also identify what is the fear you have. You receive dollars. Today dollar is $1.70. When you receive dollar, what is the fear? The dollar price going down or dollar price increasing? Going down. And going down, you want to safeguard or hedge. That means you take F minus. Or simple way to remember is I receive dollar, I'll take the contract of selling. So I say forward the foreign currency dollar, future would be F minus. That is the originality. That is the originality. Similarly, fear is what? Price going down or price going up? Price going down. Which option saves you from price going down? Put option. So in option market you will take PP. Once again, in the exporter, basic rule is he will receive foreign currency, he will sell foreign currency. When he receives foreign currency, he will take contract of selling. So it's F minus or P plus. Now I went to the market and I said, sir, I want to take a contract on the dollar. He said, we do not have a contract on the dollar, speak in the rupee. Simple phenomena is, what would have happened? Let's suppose this is my box of the dollars. From the home, I take box of a dollar. In return, I will get what? Rupee. Selling of a dollar is as good as buying of a rupee. Again, I am saying selling of a dollar is as good as buying of a rupee. It means if you go for F minus on the dollars and the contract on the dollars is not available and he says speak in the rupee term. For example, contract size was in rupee. So I'll say it's okay. Ultimately I have to sell dollars and get what? I'll say F plus on. I'll try to prove. I think I would have taken example. I'll try to prove also if time permits. Otherwise, you should know F minus on dollar is as good as F plus on rupee. Put option on this as good as a call option on this. We are not becoming a writer here because writer is not hedging. We're trying to hedge ourselves. Future market says what has to be remember. What I have put here is original rule. I'll put of the exporter was selling of a currency either F minus or Q option. In case the contracts are not available in the dollar terms, in the rupee term we'll take plus the F plus or C plus. Now second part, when we go in the second option, importer rule is what? He need. If he needs, he'll do what? Buy. The fear is price going up. Price going up, the future will be F plus. It's a buying basically. Buying is F plus dollar. Option market is which option will save you from upside? Call option. Either it's F plus or C plus which comes out. F plus or C plus. In case the contracts are not available on F plus and C plus, then you'll take the contract on what? Home currency F minus and plus. So basically F plus of one currency is as good as F minus of the second currency, and C plus of the one currency is as good as what? C plus of the second. That's fine. Now let me go back some simple examples. Show you how exactly hedging is done. I've taken a very short example. Importer needs, let's suppose, dollar 1 lakh. He went to the future market F plus on dollar and he wanted to buy dollars, and the contract on dollars is available at 62. Since the contract is available, he would have done what? F plus on the dollar. After 3 months, rate became either 50, 52 or 70. Now, dollar if confuses you, to assume you've done the betting of buying one share at what rupees? 62. You will benefit when the price goes up. You will benefit which market? Future market. Actually, this chapter tells you exact meaning of hedging, but let's do as if we are doing a normal derivative. I have taken the contract to buy one share at 62. I'll benefit when the price goes up. If the price goes down, I'll be what? Loss. If it remains 62, I'll be no profit, no loss. If it becomes 70, I'll be at what? Profit. Now, if it becomes 50, loss of what? 12. If it becomes 70, profit of what? 8. So, future market tells me that if the price goes down, you will have to pay me. If the price goes up, you will have to, I'll give you something. Now, I was the actually importer, future market is settled. Then I went to the cash market. Since I required to buy dollars, I went to the cash market and I said, I want to buy the dollars. Cash market, assuming cash market name, it was same as the future market, gave me at what? 50. He gave me at what? 2. He gave me at what? 70. No matter what the price has become, if actually the cash market and future market prices are same, then whatever future market promises to you, your costing will be at that, no matter what happens. He said 62. If by chance actual market price rate becomes more than that, then when I go to the market, I would be buying at a 70. But future market promised me your costing will not increase above 62. 8 rupees future market will compensate. From the cash market, I will buy at what? 70. My net costing comes what? 62. When future market promised me 62, when the market price became 50, I was very happy. Market price is 50, but future market said, I told you your costing has to be 62, so you give me 12. Basically 50 rupees I buy the actual dollars. Sir, why are we buying actual dollar? Because I'm importer. I'll buy the actual dollar at 50. 12 rupees I'll pay to whom? To the 12 rupees I'll pay to the future market, and total costing will come what? And if the price is 62, future market does not give me anything, neither takes me anything. I went to the cash market and my costing. Understand? If you're able to, then some approximate times is based on this philosophy only. And I think student makes a mistake. Maybe because he is not able to understand that what he is doing, one transaction is future market, second transaction is cash market. If he would not have taken any kind of a future contract, then in this case, first case is costing was, second case 60, third case 70. Future market promises him your costing will be 62. and which we will know when we start the question what is the promise by the future market. And he says, if by chance the cost goes above 60, I'll compensate you. If the cost is below 60, you give me something, your net cost is 60. Option market. Now I'm going to option market. Option market gave me $1 C plus. Means I have taken the call option, buy the share at 60. I've taken the call. Sir, why? Because my fear is if by chance the price goes above 62, then my costing will increase because I'm a importer. Safeguard or a hedge myself, I take a call option. So the call option I'm taking, in a way of reading languages, I've taken the call option on the share. I'm not even reading dollar because it gives me a confusion. I am buying a call option on the share at rupees 62. This will give me profit when the price becomes what? Above 62. If the price is below 62, option would lapse. That means if the price is 50, option would lapse. If the price is 62, it's indifferent. If the price is 70, call option will give me 8 rupees. Now, advantage of call option is if the price becomes 50, the call option would lapse. I'll go to the market and buy the share at what rate? 50. I'll buy the share at 50 only. If the price becomes 60, call option would again lapse. It's indifferent. I'll buy at 62. The price becomes 70. I went to the cash market. My costing was 70, but 8 rupees. Who compensated me? The option market. In this case, identify the difference in the future and the option market is option market protects you from the upside and gives you benefit of the downside. The future market makes you everything same. Then sir, why does anyone goes for the future market and not the option market? Because option market in could be very heavy. Understand the philosophy of the topic, please. Things you need to remember is one. Once you remember exposure, remember his original rule that selling F minus or P plus. If it is not available, second currency would be F plus. Importer basic rule is buying F plus or C plus. That F plus or C plus is not available, then second would be F minus or plus. And then whatever future market promises you, he'll compensate you. There would be slight difference which will come because the cash market rate might not be same market rate. And the option market will compensate you. If you have taken C plus, it will protect you from the upside. If you have taken put option, from the downside. That's fine. That's a basic rule of the and now let me look at the question. I'll do the options. Let's look at number 3 first. Out. Let me read out question number 3. It says on 19th April, following are the spot rates. Sorry, Euro USD 1.2, USD INR 44.8. Now, first part is by looking at the way of presentation, the practical oriented rates. Read $1 is equal to 44, 1 euro is equal to dollar 1.2. Rupee relationship is given, rest of the relationship accordingly can be made. Sorry. Following are the European options. Currency pairs call strike premium. Since premium is in dollar, that means euro is a betting contract. Euro is a betting contract. USD. A trader sells at the money spot straddle. Straddle is same strike price. If any confusion comes now, let's see. A trader sells at the money spot straddle month July 19. July 19 is the contract available on euro. Euro is a commodity. That means it's 1.2, 1.2 and spot price is also 1. Straddle means same strike price. So prices are same, so automatically it's the same strike price. You do not have to bother about it. And at the money, why he says 1.2, 1.2. Basically what he has done, he has done C minus on share at 1.2. He has done P minus on share. Euro I am treating as a share only. Trader sells seller C minus at 1.2 and at 1.2. Call option return, put option return. Now when I was doing with you derivatives, I told you do not look at minus first. Only look at what sign? C, call. Call would be exercised when price up. After 3 months, spot rate becomes one share is $1.29. I'm not even reading euro. One share is 1.29. Price has gone up or gone down? Up. Call option would be exercise or lapse? Exercise. Now see, he is a holder writer. It will be a loss or profit? Loss. Understand what I'm saying? Call option is call option. Call option would be exercised when price goes up. You were betting at 1.2, price has become 1.29. Holder will gain, writer will lose. So how much he'll lose because of call option? 0.09. Put option would be exercised when price false. This has gone up, option would lapse. So put option would lapse. That means his gross loss is 0.09, and since he was a writer, he received how much premium? 0.035 and 0.04. 0.035 and 0.04, how much? 0.075. His net loss would be equal to what? 0.015, because gross minus way of presentation. I was talking. Page 3 and solution 3 markers are important. Please. Trader sells at the money spot straddle expiring this. Short straddle sells C minus. Return call option on one share 1.0, inflow of premium 0.035. Return put option P minus at 1.20, inflow of premium 0.04. Total premium received 0.075. On expiry, price becomes what? 1.29. Put option would lapse. Call option would be exercised against the writer. Loss to the writer 0.09. Net loss to the writer 0.015. That's the net loss to the writer, which so because premium he received was 0.075 and gross loss is point. Second part we read. First part was it was normal call option, the euro. Second part which strategy gives profit to the dealer? 5 months later, September 19. September 19 is basically contract on the dollars now. Expected spot rate is 45. Also calculate profit and loss for transaction 1. Now he has given which strategy gives profit to the dealer. He has asked you whether you will become a writer or a holder. Actually wordings are not very clear. We'll assume only one thing. What is your price of a share? 44.8. Expected price to become is what? 45. Price going up, which type of option would give you profit? Call option. Either you become call option holder or become what? Put writer. Call option holder, if you become, you'll pay the premium and you'll enjoy the upside. Put writer, put option would lapse. I have shown both, but we'll do in exam 1. How will you do it? We'll do this way. Let's suppose you become a put writer. Put writer you become at 44.8 and price becomes what? 45. Put option would lapse. How much premium will receive? 0.04. That means put writing will give you 0.04. What is the price here? Price is which? Rupee, and commodity is what? Dollar. So dollar is the share. Answer will come rupees 0.04. Let's suppose you become a holder. You buy the share at what rate? 44.8. Price will become what? 45. How much gross profit? 20. And how much premium you paid? 1 2. Difference is 0.08. Call option gives you call option gives you 0.08. Put writing gives you what? 0.04. Which one is better off? So he told the trader can do anything. He can become a holder. Who stops him? Now look at the way I write the answer. Since expectation is price rise, a dealer can become either a call option holder or put writer. Can become any one of them. I have become a put writer, but I have cut them. I have not shown it, and maybe I'll not show in the exam. Show only once. Put return at 44.8 in expiry. The price becomes 45. Option will lapse. Net gain is 0.04. And if you become a call option holder, then you buy the share at 44.8. Outflow of premium 0.08. 45 the price becomes, call option would be exercised in favor. Gross profit how much? 0.20. Premium paid 0.12. Net profit 0.08. And total profit he said how much? 1.5 million. So 15 lakh into 0.08. 1 has not come for a long time. Once you've done this, one question, derivative side. Read this once. I think one of the questions we left in the derivatives chapter. One part we'll do after consider 43rd question. Third. Go back to 43rd. That question has been modified by the institute, I think. I'll tell you what exactly modification is required. Forex chapter, there was 42nd part was there. At this point. Importer A Limited. A Limited of UK has imported some chemical worth rupees USD 4897 from one of the US suppliers. Amount is payable in 6 months time. Relevant spot and forward rates are as follows. Forward rates of interest in the money market are. Now this, before I read further, he's an importer and he has to make a payment of what? Dollar. Originally, if I start thinking he should be buying in the future market, if future market is there, then he should do what? F plus on dollar. And in the option market should do E plus on. That should be done because he need to buy. His fear is price going up, and price going up, hedging would be done by F plus or C plus. Now when I went to the market, and this was available. Currency options are available under which one option contract is G 12,500, but the contract is not available on the dollars. It is available on pound, and since it's option, that means I required C plus on dollar, But since the contract is not available C plus and dollar, I'll have to do what? So basically look at the way I do. I said I went to the market, said I need to buy dollars. Said dollar contract are not available. What I wanted to do was, from the home, I would have taken pound, I would have given them pound and taken what? Dollars. Language I wanted to speak was I want to buy dollars. But they said do not speak in the dollar term, speak in the pound term. So how does it make a difference? Buying of a dollar is as good as what? Selling of the pound. Understand what I'm saying? So if C plus on one currency is not available, then second currency you do what? Selling. Now when I went, I said I want to sell dollar, a pound. They said ha, now it's okay. It's one of the same thing. When I sell pound, I'll get what? Dollars only. So basically the language I'll use is, instead of C plus on dollar, I'll go for what? P plus on pound. That is the basic difference which has come. Now I will, from the home, basically actually what should have been there? From the home when I went, I should have taken the boxes of the dollars, but instead now I'll make boxes of the pound and I'll sell. And I'll make so many boxes, or I'll create such a strategy in which at the end in hand I should get what? 364,897 dollars. Now it says currency options are available under which one option contract is GBP 12,500. Option premium for GBP strike price of USD 1.7 GBP is 0.037 for call option, irrelevant call option. Actually lines are so very confusing. He can simply give you that what is this price. Price is, if you give 1 GBP you will get how many dollars? 1.7, and you do not even have the option to compare. It will lapse or exercise, lapse exercise, because data is not available. It simply means in this kind of a question, 1 GBP you give and you bring back home how many dollars? 1.7. That means if you do C plus on this, premium was 0.037, which is not required, and premium required is 0.096. That means I'll do the contract now. If I put the language I put, since UK is an importer, it required to buy dollars, that is it wanted to go for C plus on dollar, but because C plus on dollar was not available, it will have to go for P plus on pound. So basically from home he'll take the boxes of the pound, and with respect to 1 pound he'll get back $1 1.7. And what has to be done with this? No. But since UK is his home currency, the ultimate answer will convert in pound. What we need is, we have to check how many pounds would be required using this option market to buy 364,897. Now I'll create some sentences talking to you exactly same way you'll do in the exam. How many dollars required? Do not copy anything, just keep telling me. 364,897. These are the dollars required. From the home, I'll take a box of the pound in which I'll fill the pound, and then they said how many pound should be put in one box? 12,500. From the home I'll take one box of 12,500 pound. I took to the market, and with respect to this box, when I give it, they'll return back to me one box of what? Dollar. And 1 pound is equal to how many dollars? Basically I have these shares 12,500. I'll give it to them, and they'll give me with respect to that how much? 1.7. That means they'll give me how many dollars? 1.7 into 12,500. That means I'll give you one box of pound of 12,500. You'll return back me box of dollar, which will be 21,250. Total how much dollars we require? 364,897. If I'm getting in one box 21,250 dollars, then how many boxes or contracts I should do? 364,897 divided by this, how much? 17.17. Since it cannot be in decimals, we'll do 17 contracts. Now in 17 contracts, I'll see, that means from home I'll take 17 boxes of pound and I'll bring back 17 boxes of dollar. In one box of a dollar, how much comes? 21,250. In 17 boxes of dollar, how many boxes, how many dollars will come? 21,250 into 17, 61. We get 361,250. Requirement was what? 897. You get what? 361,250. Shortfall is equal to 367. Shortfall comes 36. And it is actually when you have a birthday party at a home, you bring a tetra pack of a fruity. One tetra pack fruity comes how many? 12. 12 only. No, you have become big enough, but I know still fruities home you cannot bring 12 boxes. 52 friends are coming. Will bring how many boxes? 4 boxes. That will be equal to 48. Balance you'll say go back home. Balance you'll buy what? Lose you buy. I know article does not get time to celebrate, but does not even remember when the birthday is. Only remembers the date of GST, income tax, exam dates, your birthday, someone else's birthday comes out. For small children used office, how many prints? 1 each. That was good. Good. Before you buy what? You required 364,897 in the boxes will come 361,50. 3647 you will buy by forward contract. That means you will enter into forward contract, buy the balance. And then how many contracts you have done the agreement for? 17. If you look at the put option, our premium was what? 0.096. That means I would have paid some premium also in the 0.096 on £1 in one box. There was 12,517 boxes. How much? 1,400. Now basically I need to find out the costing for 361,250, how much pound was spent. For 3647, how much pound was spent? 20,400, how much pound? That is my pound cost. How we'll do it? Again, I am reading the sentences, please. I wanted to buy C plus on the dollar. Since the contract on the dollars were not available, I'll go for put option on the pound. I required $364,897 from the home. I took a box of 12,500. Return back, I get a box of 21,250. Then I want to find out how many boxes. 364,897 divided by 21,250. 17 boxes. The balance in 17 boxes come 361,250. Balance would be covered by forward market, and since it was a put option, we have taken. I cannot leave my answer in the dollar term because he's a UK and he has to compare with the money market operation forward contract. Ultimately, this answer has to be converted into pound term. What we do exactly? It numbers. It slide. UK is equal to importer. We need $364,897. What rate? £1 is equal to $1.5175673, and this is the cross relation I have calculated. Dollar, pound, and dollar. Since UK is an importer, sir, do we need to write this line? It's up to you. I have a habit of writing because I want to be very clear that why I am taking action. Since UK is an importer, it needs to buy dollars, but that is it needs plus on the dollar. But the contracts are available on the pound. Hence, they will have to go for P plus on pound. And the rate agreed is P plus is plus done £1 is equal to 1.70. Now steps are I require $368.97. One contract gives me pound of 12,500. In one box I give and bring back one box in 1.7 21,250. Contract comes 71.17. Round off is 7. 17 contracts we get 361. Shortfall to be covered by forward market 3647, and option premium what I pay 0.096 into 12,517. Now what I need is I need how much pound for this. I'm highlighting in yellow. How much pound required for this? How much pound required for this? How much pound? For 361,250 there is no challenge because you took 17 boxes of 12,500. That will be exactly same comes out. 3647 forward market you are buying, so you'll be applying what rate? $1 6 months forward 1.5455. Premium would be paid in what time period? Premium would be paid in what time period? 0. So I'll apply the 0 time period. Basically what I find my costing is now I say pound equivalent cost is 2,12,500. That's basically 17 boxes by 361,250. 3647 were bought in which market? Forward 2360. The pound required to buy 20,400 in what time period? 0 time period. My costing is this, divided by 1.5617. One part which your institute, some other question has changed. In this particular question, I think they have mentioned that since you are paying in 0 period, there would be an opportunity cost. So this cost I have calculated. They have only put the line, reason being because they will have to modify the answer, maybe not modify. When you go back home, I think open up and they'll write this line below the answer. In one of the questions, I have not taken it here. When you go back home, they have modified the answer also recently. This will be 13063. That means I might have taken a loan in this. So why are we taking opportunity cost? Because if I do not take opportunity cost here, in money market operation which I have taken, I take the cost on the totality from the 0 period. So I have to assume a costing here. This is something which may be not there in the answers you have, but they have written the line opportunity cost can be taken. It is not can be taken, it should be taken. Otherwise the apple to apple comparison is not possible, because money market operation you take the entire costing. If I assume that 13063 pounds were available with me, then in any other option I would be borrowing lesser by this. So basically this is one costing which comes, this is second costing, third is premium cost since it was in 0 period, and we have the opportunity. Please check one. The objective should be very clear. What you wanted was not available, hence you went for the reverse calculation of it. Has been coming regularly on and off, very comfortable. Go back home, you try out once again. The only difference in the normal and this question was he did not ask you to compare whether option would be exercisable or not. Some questions he might give you, for example in the previous question he gave strike price was something, at the end price was something, so it's a lapse or exercisable. In this case you have to assume whatever rate has been decided, at that rate only you are buying it. And make it in a flow. You cannot read the sentences. Dollars required, pound contract size, that means from in one box how many pounds, reverse back how many dollars, how many boxes required, in boxes rounding off how many dollars would come, balance would be shortfall, that would be by forward contract, then the premium cost comes out, and then three costing, the box costing, the costing, forward contract, convert in the pound term. And be very careful, premium is paid in 0, so rate would be applied the 0 period. Dollar is a confirmed currency, keep dollar on the left hand side, left to right will multiply. The 6 months forward rate for the forward, dollar is a confirmed currency, left side dollar, left to right will multiply accordingly. This is another question. One question which came in November 13. Coming back to prima facie, very weird question. We could have done by n number of ways actually. He should give you actually when we'll do the futures, say rounding off we have done the lower. Rounding off lower we have done is because it was coming 70.17. One of the questions can do the higher also. Then there could be some other ways of looking at. If I do the lower rounding off, better higher rounding off. We are avoiding that confusion. He will tell you in the futures. Generally, when question comes now, for example, calculate. He'll say, for example, he'll say the nearest whole number. He'll give this kind of a line. Actually, I think he should be giving me that kind of a line which comes. Question number 5. Prima facie, this will look very odd question. Try whatever best you can do. Do not look at the answer. Saying again, do not look at the answer. This is for almost now more than 11 years, 11, 12 years, almost 11 years now, can repeat back. Currencies could be different. Question was not tough. Even second time when it comes. First time, number 13 was very odd paper. I cannot say that you could have done. But second time when it comes, this will be one of the simplest questions. Read once, try to make whatever best you can do. For 5 minutes, I give it to you. American firm is under obligation to pay interest dollar 10 lakh 1st July and 30. Requirement is Canadian dollars. Firm is risk averse. Risk averse is who does not called risk or risk averse. Policy is to the risk involved in all foreign currency. Finance manager of the firm is thinking of the risk forward contract option contracts. It is now June 30. July 31 is 1 month forward. September is 3 months forward. And following quote of dollar per Canadian dollar. Dollar per Canadian dollar. Very clearly language given. 1 Canadian dollar. How many? And confirmed currency is Canadian dollar. Canadian dollar is on the left hand problem. Spot rate is of no use. 1 month forward. This is 1 Canadian dollar. 1 Canadian dollar. Means if I take a 1 month forward contract, I'll simply multiply 10 lakh 10,000 into 0.9301. 10 lakh 10,000 into 0.9301. That's it. That will be my dollar. How much do we get? 939. And second one we have 0.9356 into sorry 0.9356 into 659 939 16598. Now next, this is forward is done. Price for this is actually confusing language. If it confuses, let's try to find our objective. Find what is the price of commodity. Price for Canadian dollar per dollar on option per Canadian dollar payable on purchase. Contract size Canadian dollar 50,000 R. Now I could not make out first chance. I could make out one thing, contract size in Canadian dollar. That means Canadian dollar is a commodity, price is dollar, and we required buy or sell. Buy means call option. We require call option on Canadian dollar. That means option is irrelevant. So I cut down the put option altogether. Basically, you have to cut. This question was very confusing in the data points. I require Canadian dollar. How to read the following sentence? Don't worry, because I need to buy Canadian dollar. Contract size is in which Canadian dollar? It means I need to buy. I need a call option. Put option is irrelevant for me. Now, second part, he has given different strike prices. So what are these? Basically, actually, what is there is this 1 Canadian dollar is equal to dollar. 1 Canadian dollar is equal to dollar. 3 strike prices. We do not know which contract will take July, September, etc. Second, he said cents per Canadian dollar payable on purchase of the option. Cents per Canadian dollar payable on purchase of the option is option premium. It certainly cannot happen that strike price is 0.93 and premium is 1.56. This will be read as actually 0.0156. 100 cents make $1. 100 cents make $1. 100 paisa makes na. For example, you cannot have that 0.93 is the dollar. 1 Canadian dollar is 0.93 and premium is $1.56. It cannot happen. Price is dollar, premium is in dollar. The cents per Canadian dollar. Cents means 1.56 means so 156. 1.02 means 0.01 to dollar term. I say how it is read. But what to take a contract I don't know. But one thing I know, I need to buy Canadian dollar and I have to take a contract of the Canadian dollar. Then I go further line. I say according to the suggestion of finance manager, if the option are to be used, 1 month option should be bought at a strike price of 94 cents as good as 0.94. So which option? This option. 1 month. 1.02. That means the first one is of no use and third one is of no use. Is that basically you have to buy 1 month option, months option. Now in 1 month 3 strike prices are given. Which strike price option? He will have to tell you. Says buy 94 cent option. That means premium paid would be 0.0102. And for 3 months at a strike price of 95. That means 1.64. Premium would be 0.0164. Now, how many dollars in the July? Just a month. 10 lakh, 10,000. Contract sizes divide by 50,000. You'll get something 20.2. Basically, point 0.2 is extra. That 10,000 is extra. 10,000. If nothing is said, you'll do what? Forward. Now he creates a problem. Says, and for the remainder uncovered by the option, firm would bear the risk itself. Okay. For this, it would use forward rate as the best. What that means? Forward rate. Not have given this. I was much better off. I would have taken what? Forward contract for the balance part. Transaction costs are to be ignored. Recommend which of methods would hedges foreign currency. The first part, first answer we got already forward contracts. Now let's verbally do the options. 10 lakh 10,000 divide by 50. You said 20 point how many contracts? Round off to 20 contracts. Basically 10 lakh Canadian dollars you will buy at 0.94. Costing will be 9 lakh 40,000. The balance 10,000 you will buy at what? 0.9301. So 10,000 into 0.9301. It's 9301 only. 9 lakh 40,000 plus 9301. Two costing came. Third costing would be of what? Premium. 0.0102 into 50,000 into how many contracts? 20. 10,002. My total comes is. If I go and try to check 5. At this place. Is 5 in payments. 31st July, 30th September, Canadian dollar 10 lakh 10,000, Canadian dollar 7 lakh 5,000. Forward contract 1 month forward, 1 Canadian dollar 0.9301. Dollar required to buy this straight forward. Dollar required to buy this straight forward. Option contract of 31st July, 1 Canadian dollar 0.94. Why did you cut down the put option? Because we required the call option and dollar call option was. We do not require anything from the put option. And out of that 6 also we need only 2. 94 cents of the July and 95 for the September. Number of contracts 10 lakh 10 by 50, 20.2 round off to 20. Canadian dollar in 20 contracts would be how much? 10 lakh. Balance Canadian dollar you will buy from the forward. 9.2.94, 9 lakh 40. 10,000 into 0.9301, that's a forward contract. Get 9301. Premium cost would be 0.0102. 50,000 into 2002. The case of the second one, how much is total? 7 lakh 5,000. 7 lakh 5,000 divided by 50, get 41. Round off to what? 14. 14 into 50,000 is 7 lakh. Balance 5,000 will buy by using what? Forward contract. So 7 lakh into 0.95, that was the strike rate. 5. 5,000 to 0.935678, and premium cost would be, sir, 0.161. 150. Decision: forward contract is better under both. 31st July forward contract had to be better, because if you look at the forward contract rates, 0.9301. This option was 0.94 plus the premium. That would not be better off. This costing was 9356, whereas this was, it was prima facie visible that your forward contract would be better off under checkout ones. Now moving into the futures, I've taken working for the future, and whether you do F plus, F minus, that it would get this part. Slide number 9. I've taken exporter will receive $1 lakh, $1 lakh after 3 year contract on dollar is equal at $1.65. Show the position of the exporter if the rate after 3 following. Now understand first philosophy. He will receive dollar, he will buy dollar or sell dollars. Sell. Dollar contract is available and it required selling of the dollars. F minus on dollar at $1.05. What is the promise done by the future market? 5. If cash market gives him 65, future market says okay. If cash market gives him less than 65, will compensate. Future market will compensate. If cash market is giving more than 65, future market will take away. The rate is 60. Let's not even talk future will exercise or etc. Let's speak simple words. He was promised how much? 65. If cash market gives him 60, future market will give him 5. And we can see, not read $1.65. You have taken the contract to sell share at 60. Taken the contract to sell 5. Share price fell to 60. How much future market will give? 5. 5 rupees will come from the future market. That 5 into 1 lakh is 5 lakh. Plus something will come from what? Selling of these dollars in which market? Cash market. Your net will come 65 lakhs. The rate is 65. Then you took the agreement to sell the share at 65. Price is 65. No gain. Loss comes out. If the no loss or no gain comes out, basically what will happen is your net realization 5 only. Third case, if the rate becomes what? 70. The rate becomes 70. Cash market you will be able to realize how much? 70 lakh. You will be able to realize 70 lakh. Whereas the future market promised you what? 65. He will take away 5 rupees. Ultimate per hand would come 5. This case can be only checked with cash and the right rates. Basically $1.65, $1.70. So same example I have reversed here. Let's suppose same data points. Previous example. The contract is available on rupee. Now instead of dollar, it is available. And if you try to check, I have converted the rate 1 rupee $0.015, exactly rounding off 1 divided. That means for exporter wanted F minus on dollar. Since F minus on dollar was not available, for what? Plus 1, and it would give profit when the price increases. Now understand, price of what? Price of rupee. Earlier it was price of dollar because commodity was dollar in the previous example. In this commodity is rupee. He says tell the exporter after 3 rate becomes this. Now if the rupee rate becomes $0.0167, do not even apply the brain. Wanted to for exporter, you want to take F minus on dollar. F minus on dollar was not available. For F plus 1. F plus 1 said you will buy one share at $0.0154. Share price became $0.0167. Went up or went down? Up. Profit or loss? Profit. How much profit? 0.0167 minus 0.014. 0.0013. 0.0013. The only difference in the previous and this example is, previous example even 7th class, if you tell him I am promising 5, market is giving how much should I? 5 rupees. 5 into 1 lakh dollar, 5 lakh. Exactly thing is happening here also. Exactly thing is happening in the next example. To divide 1 divided by 0.0154, it was 5. To divide 1 divided by 0.0167, it is 60. So basically, if you compare, if future market was compensating you here, he was compensating in first example in the rupee because price was rupee. In the second example, since the price is dollar, he'll give you extra dollar and he'll say, have your dollar, take some dollar from me, find those dollars, go to the market and sell. I only rounding off the rate. $1 is, this is also 1 rupee as equal to the 60 rupee dollar rate. In this case, profit will come is 0.0113. Now, how many dollars he'll give me? For that, I have calculated the contract when I took on 1 plus for 1 lakh dollar equivalent, because rupee was chocolate for me, rupee was commodity. How much rupee have 65 lakh? On 1 rupee, he is giving me 0.0013 on 65 lakh shares. The one share $0.0013. My contract was done on this amount. 1 lakh dollar is equal to rupee term 65 lakh. Since the contract is done on 5 lakh, 65 lakh will give me 65 lakh chocolates in 0.0013. That will be equal to what? 8450. 8450 I'll receive which market? Future market. 1 lakh I'll receive from the importer outside. Total dollar available are what? 108,450. Now you go and sell at this rate. 108,450 divided by 0.16, rounding off it. Understand, I have taken same example to make that whether you do it currency or opposite, the answer would come same. The difference is happening is, since the contract had to dollar, whereas since we did the contract in rupee, get some extra dollars, add that extra dollar to your normal dollar, go to market and sell. You are actually selling the dollar at 60. When you are selling them at 60, ultimately comes 65 lakh. Because promise was, if you look at this rate, 1 rupee 0.0154, promise was 5 only. But realizing less than it. Sir, but we are realizing more. Actually, he is giving more dollar. That means dollar will be giving lesser rupee. Dollar will be given done. And if the rupee rate becomes $0.0154, promise was what? 0154. But promised same, getting same, nothing will come from the 1 lakh dollar come. Sell the 1 lakh dollars at rate is 65 only. Rate I have done. Third case. If you look at third case, 1 rupee is $0.014. To reconvert, it is 70. That means you were promised 65, but you are getting 70. Now, future market will take away something. How much it will take away? Your F plus on rupee. Your F plus on rupee. Price has fallen. 0.0154 minus 0.0143. 0.054 minus 0.014. How much? 0.0011. How many? This is price. And chocolates in this question is what? Rupee. 65 lakh into 0.011. So the future market will take away how much from you? 7150. You received from outside 1 lakh. Future market taking away 7150. Balance which is left 92,850. At what rate? This rate. In simple word, if I tell you, you are selling 92,850 at the rate of 70 actually. Selling 92,850 at the rate of, it is as good as 1 lakh dollar sell at the rate of 65, or 92,850 sell at the rate of 70, or 108,450 sell at the rate of 60. This will, rounding off will all. When you go back home, try to compare both. If you compare this, na, life is, and it cannot be final for sure. That 65 you promised, price becomes 65 rupees. 65 you promised, it becomes 65, nothing happens. 65 promised, 70, take away 5. Ultimately, and comes 5. Second case, same rates I have reversed. If only difference is, if there is a loss, future market will give you extra dollars. Dollar plus that extra dollar, add them, sell. If you are in a profit, future market will take away some extra dollar because your higher rate in the is 92,850 able to sell. Every question which comes in the exam comes the reverse way. Not even apply a brain. What is happening is, when you are looking at a question, first part, what is the promise done by the future? If promise is 5, my more or less answer will. Why exactly the answers do not match? Because the rate could be cash rate. Some questions they give exactly same, that we can match exactly the answer. Can I move forward? Which has come maximum number of times. I don't know, 7, 8 times. Exactly same. 3 times student some mistake. 3 times cannot take a mistake here. One, XYZ Limited is export oriented exporter based in Mumbai. Prima facie first line, they will sell foreign currency. Dollar is here. Ideally, I should F minus on dollar. My philosophy tells me dollar. Then I read further. Company invoices in customer's currency. If you are not invoicing in currency, na, there is no need of foreign exchange. For example, if I 5 lakh rupees, headache is his. I will have to get lakh rupees. Has to be currency. Receipts are dollar 1 lakh. September 1, 2005. Market in 1. And 1 we are standing. What rate is of 1 to 7 by months that he has given dollar. Whenever the question comes, first thing you should do is, this will be not applied. You're standing in June, need how many months forward? Months. Now this is given 1 rupee dollar. Let me put down for my reference purpose, $1 is how much it comes? 40, 47 point. It means forward market is promising me, if you convert, I'll give you what? 47 to 1. How did we do? Rupee dollar is very straightforward. 1 divided by 0.0127. Now contract size is in rupee. That means betting has to be done on what? Rupee. Betting has to be done on rupee. Which month contract we need? September, not June month. Standing in June, but we need contract for the month September. Is saying 1 rupee dollar this. I know I wanted F minus on dollar, but I'll go for what? Plus on. Just for my reference, that what is dollar promising? $1 is equal to 47 point. Now one thing is clear cut from depending on this date, that the market is promising me 47, one which is higher than what? The forward rate. Although I cannot do the contract, sir, here convert in the dollar rupee and do the contract, you cannot do. So you were supposed, but since the contracts are available, then you will have to go. Now let me go further. Initial margin, it's now this confusing. We are standing in the month of June. Contract for what? September. So margin you do September. On September 1, 2005, what rate? Actual cash market. What is the rate which comes? Actual cash market rate, spot market rate. 46, 46.88. 46. Currency future rate is this. Why the future and spot rate are different? First September cannot be last Thursday month. The rate is different. That is what I was saying. Then future is now. Look up, please. Look up. Look up. You did F plus on rupee at what? 0.02118. Rupee leave. One share you said you'll buy at what? 0.02118. And rate becomes what? 0.02134. It has gone up or gone down? Gone up. That means profit. Profit comes now. Now let me think reverse way. What is this rate actually? $1 is 46.8. Now you can imagine that you were promised what 47.1, and if you would have looked at spot only, you would have realized what is giving you loss. That loss will be compensated by whom? Future market. Basically, if I try to look at the reverse way, I get the of it. The future will give me profit or not. But prima facie in exam, I should not apply a brain. I did F plus here. This was the rate, and this goes up the profit. Now, what will happen is, so period, I'll enter into a contract in such a way. I wanted F minus $1 since I'll go for F plus, and F plus what rate on the 1st September is giving me cost is some extra amount which I'll realize from what? Future market. Future market will give me what, rupees or dollars? Price is what here? As per the question, price is what? Dollar. That will give me what? Some dollars. That dollars I'll do what? Add with my normal dollar of 1 lakh. Combine that dollar. Go to which market? Cash market. And sell at what rate? 46. More or less your answer would be approximately 47.1. Why it would not come exact same the way we were doing in the example was because your settlement rate of the future is not same as cash market rate. Understand what I'm saying? Since the spot market rate is going down, exporter was fearing future market promised him 47.21, cash market rate went down to. Ideally, if I was taking contract in dollar and if the price was rupees, then I would have get some extra rupees. But since the contract is in the rupee and price is what? Dollar, future market will give me some extra dollar. I'll add that dollar. After adding that dollar, I'll go to what market? Cash market. Sell it at this rate. Ultimately, by more or less answer would come around 47. Then it says comment with following methods. Forward contract. So forward contract is straightforward. Currency futures, hedging. No, leave everything at this rate you select off. That is altogether the last option. Because if you do not do anything, you are realizing what 46. One is exporter will dollar 1 lakh forward contract 1 rupee 0.0127 word back just reference left to right left side we what confirmed currency confirmed currency dollar left to right we multiply when we multiply we get 47.17 no hedging hedging when you have done C part first no hedging was what rate 0.021 0.0213 now it becomes 0.02 that is 48 although lot of arguments done what will happen some assumption 46 equivalent in 46,088 to now the currency future which was the topic since India is exporter it needs minus $1 originality was but the contract is available on what hence he plus on rupee wanted what minus $1 but if minus dollar was not for what plus on rupee 1st June 2005 if rupee gives you confusion one share you said you'll buy a $0.118 sir why you put bracket this one get a safety comfort that what is the promise done by the future market 47.1 and I know cash is 46 so prima facie I can make out future market has to profit that I do not make now number of contracts I is 1 lakh divided by this these are basically my rupee chocolates divided by contract size I get 10 F plus 1st September future price in the market is 1 rupee $1.134 you have done the contract to buy at what rate 0.188 rate becomes what 0.02134 price has gone up Since price is in dollar term, it will give me how many dollars per chocolate per rupee or per share? Point triple zero one six. Total shares are how many, sir? Point triple zero one six on 4,72,000 into 10 boxes. The 10 contract size. That means the market will give me how many extra dollars? 755 point. And what I'll do is 755 point dollars plus what? The 1 lakh dollar which I was supposed to receive. Total dollar available in hand are 1,00755.2 and go to which market now? Cash market and sell at what rate? Sell at what rate? This. When you sell at cash market rate in, sir, why is it not coming exactly 47? Cash market rate and future market rate was what? Ideally, the answer ideally. But since he has given margin, you took the margin for the month of what? September. 1000 into 10, margin is not your cost, but opportunity cost on that would be your costing. Your deposit is 1,50,000, that he gave 8%, 1000. Basically, my net inflow would be futures is 40,20,638 minus interest cost what? 3,000 and comes 40 30 currency higher rupee. When you go back home, the example which was done rupee and cross dollar, understand the flow of it. All questions are reverse pay. Cash market is giving loss, future give me profit. If it's the same currency, challenge if currency, give you that currency, add up the all the currency, check it one. Done? Right? Question. Nitrogen limited companies water amount large German retailer on a successful time nitrogen Solving three alternatives for managing transaction order is: invoice the German firm sterling, invoice German pound, current exchange, calculate the billing in the challenge is not there. Party has worried about, not have any about it. 40 lakh at the period, you can at the current pound, give the bill pound. Alternative, second option, invoicing the German firm in euro. Forward contract to transaction, forward contract, forward contract. Third, invoice the firm in euro. Again, different currency, foreign currency basis for the UK. Sufficient 6 months sterling to convert to the hedge the forward contract. Following is available, what rate is available, or in then we have a 6 months forward premium. Problem was are given in high low. High low is points. Answer point 0.6. Either you use or a discount. Not 6 point 000055. 6 months future is at 1.17. Contract size in pound, whereas wanted F minus on third case that firm would be billing in euro, whereas contract is available on pound. Will have to go. Third part I'll come separately. First two parts. What rate and are £1 is equal to first two parts. Third part I'll come separately. Third part will discuss. I think this will be important future are same. Whatever is the promise exactly same. Tell me the case importer 40 lakh. Voice the German firm. Confirmed currency is euro. I was given £1 is equal to 1.175, 1.77. If I convert back the £1 term to term, 1 euro is equal to pound, 1 divided by 177, 1 divided by 1.715, and it's a exporter's case. Let's suppose, how do you think is, if you would have received pay, you would have done the contract to buy or sell, done the contract to sell. Would I sell, bank will do what? Buying. So, left to right. You have taken the contract to buy, bid rate applied, that means in pound, then pound flow would have been 33.98, 33.71. Second part is any of the answers, because you were given the word premium, you can add and show, although they are taken because they were given in high low. 0.6 by £1, whereas confirmed currency, in this case I have taken it for case only, for case only. So I convert back euro side, left to right you go multiply 33.82. Second case, because we'll be selling forward rate. First was a spot rate, second is a forward rate. Pound equivalent info, either of the two answers you can write in the accordingly your forward rate this time onward. First time. Third was important when I said when we do futures contract, since UK is an exporter, it needs what? Minus on euro. But the contract is available pound. Hence, it will have to go. Again, I'm saying, since UK is an exporter, minus on, but the contract is available in pound. Hence, for what? Pound. Nitrogen liquid will go for F pound. 1 pound is this promise done to you. What? One give you how much? 5. If the what was the cash market rate? Forward rate 1 point. At the end 1 point. It becomes 1 pound to 1.85. Now look up please. You are doing F plus on 1 share at the rate 1.17. 1 share becomes 1.1785. The market will give profit. It's 100% surety cash market would giving you loss, and that's loss is compensated. If I convert this 1 euro pound term 1 divided by 1.17, can roughly how much number it gives? Point. Now look up please. The future market promised you what? 8503. Cash market is giving you what? 0.8485. Now ideally, if things were given straightforward, he would have given you local currency. Now since things were not straightforward, what he'll say is, as per him, the price is what? Euro. As per the question, price is euro. He'll say, I'll compensate you some extra euro. You have your own euro, add them up and go to which market? Cash market and sell. At what I promised you was what? 8503. Your net realization as 8. Basically, you do one thing. If let's suppose 40,000 would have come, let's suppose 40,000 would 40 lakh would have, and if you would convert at this rate, how much would come in hand? 0.8503. 3401 something. 3401 something na. If let's suppose, that means future market is promising you in hand would come 34 lakh 01 something, and since your spot and future market rate are same, and cash market is giving you how much? 0.8485. Convert 40 lakh into 0.8485. 3 lakh something is coming. That means difference whatever is there na, that would be compensated by whom? The future market. But future market will not compensate you pound. He'll give you extra euro. Why? Because as per the future market price is what? Euro. He'll give you extra euro. That euro you add to your 40 lakh euro, go to the cash market and sell at this rate. Ultimately in hand would be whatever you would have got, 0.8503 into what? 40 lakh. Basic understanding of the question. And future market saying, I would give you 40 lakh into 0.8503. I went to him and said, cash market is giving. He said, don't worry, 40 lakh you have your own. I'll give you something extra euro, and I'll give you so much extra euro, add and sell at this rate. Ultimately in hand realization what? 0.85. Prima facie you can make out whether the future market will gain or loss. And if you try to look at the data, had done plus at 1.1760 and price becomes 1.1785. That means the gain. That gain is because cash market is taking away something. You have an extra amount of euro, go and sell your net realization. That will cross check at the end once again. What we do here is F plus on 1 share at the rate 1.17. After 6, the price becomes 1 pound is equal to 1.1785. Profit in the futures on 1 pound 0.005, and price as per the future market is, he says, I'll give you how much? 0.0025 in 1500, rounding of 50. So you'll get extra euro the future market, and 40 lakh you'll receive from where? So it will become 40 lakh 84, 840 lakh, 8,004, and go and sell at what rate? Cash market rate. What market rate? And comes what? 34,01,305. If you try to cross check your answer, try cross check your answer. Let's suppose what rate was promised by the forward was, there was 1 pound is 1.17, 1 euro pound 1 divided by, convert 40 lakh at this promise. It should come roughly 34, 1 rounding of promise. Understand what has happened. There is no rocket science. Prima facie out whatever future was promising. If I am getting lesser than that, the market will compensate much extra, such that when I add that extra and sell at the cash market rate, ultimately what was the promise done by him? That is, same was happening in the previous question, happening in the example. The only problem and the cross check cannot happen in the exam is when your spot and the future market are slightly different. In this case, since spot and the future rate are same, clear cut I can make out. My promise is 0.850, cash market 85. Ultimate that has to be compensated by. Check out quickly currency derivatives. Done. Wind up here only. Start with the